Mixed economic picture, at least mixed data. Durable goods orders falling for the first time in a year, and jobless claims on the plus side hitting a new pandemic low. Joining us now for an exclusive interview is Dallas Federal Reserve President Robert Kaplan. President Kaplan, welcome back to the show. Good to see you.
Good to see you, Sarah.
You have really led this discussion lately around tapering. You're actually talking about tapering, not just talking about tapering. Do you still think that's appropriate, given we've seen now a streak of economic data misses, including the last jobs report?
I think this recovery is going to be a little bit unusual and in fits and starts because of these supply issues that we're seeing, which I think for us helps explain some of these data releases. But I think we're in a recovery. We're moving toward weathering the pandemic. I think we're going to be making progress toward full employment and price stability. And I've said, based on that, sooner rather than later, I think it would be wise to start talking about moderating some of these asset purchases that we put in place during the crisis. But I think maybe the efficacy of these versus the side effects, I think that balance is changing as we're emerging from the crisis and making progress. I guess, for lack of a better analogy, I've said I think it'd be wise sooner rather than later to begin gently taking our foot off the accelerator so we can avoid and reduce the probability of having to apply the brakes down the road.
So what sort of negative consequences are you worried about if you were to take too long? How has the calculus changed for you?
So we're watching very carefully. I'm watching very carefully. In the financial markets, keeping our eye on excess risk-taking, understanding that when rates are at zero and we're also buying these asset purchases, it creates a lot of liquidity and people are going out the risk curve. But in particular, we're watching the housing market where single-family home levels are historically elevated. But I think more than that, we're seeing single families competing with private investors who are also buying homes fully furnished to rent. And I think it's my own view that at this stage, as opposed to a year ago, these mortgage purchases, for example, might be having some unintended consequences and side effects, which I think we need to weigh against the efficacy. And so I think some restraint and moderation as we move toward weathering this pandemic, I think would be useful in mitigating some of these excesses and imbalances.
Do you think you're on your own with that sort of perspective? Certainly when we hear Chair Powell and his public appearances and public comments, he seems not to share any of those concerns at all.
So I guess I won't comment on the group or where we are. We obviously will have a meeting here in mid-June. We will, as we always do, share our views. I think one of the great things about Chair Powell and his leadership is he encourages me to express my views, to debate, to disagree. And out of that process, I think we'll make better decisions. And so I'm confident that we'll have a good process and we'll each bring to that what we're seeing and debate and disagree and come up with appropriate policy.
Very civilized response and discussion around the Fed table. So you mentioned you're watching asset bubbles, you're watching the housing market. What about inflation overall, President Kaplan? Are you worried that the economy is overheating and the Fed could would be behind the curve if it didn't move sooner rather than later?
We've got cross currents we're observing as it relates to inflation. You've got the cyclical elements of it that not only have to do with the normal business cycle, but the reopening, which is understandable that as we reopen, you're going to see price pressures, and we're seeing that. But we also have a number of structural elements. You see CapEx behavior changing in a number of raw materials industries. We're seeing, in examples, the semiconductor industry has got substantial CapEx that needs to be spent. And against that, you've got some other trends like more infrastructure spending coming, which will increase demand particularly for some of these materials. You've got the greening of the economy, which will change supply demand. And on the labor side, we've been talking for years about the aging of the workforce. And, we think since February of 2020, 2.5 million workers have self-identified as retired. Another 1.5 million are women with children who are home with their kids. And so I think some of these supply-demand issues may be somewhat persistent here. And so my job is not to put a label on it or to know exactly the outcome, but it is to be open to a range of outcomes and manage the risk, understanding our commitment is to anchor inflation expectations at 2%. And this is why, from a risk management point of view, as it relates to this, I think, again, taking the foot off the accelerator here very gently may help be a factor in managing these risks.
Shepard Smith here. Thanks for watching CNBC on YouTube.